Right now, one of the best performing stocks in America isn't a shiny new tech startup. It's not an artificial intelligence lab. It's a chain of pawn shops. I want you to sit with how strange that is for a second, because it tells you everything you need to know about the real American economy. Picture a guy named Jacob. He lives in suburban Detroit, makes about $80,000 a year as an HVAC tech, and by every official metric, he's doing just fine. But tomorrow, he's pawning his $3,000 Snap-on tool set, the exact tools he needs to make a living, just to bridge the gap until Friday's paycheck. Here's the part that should keep you up at night. The company that just took Jacob's tools, its stock has doubled in a year, absolutely crushing the broader market. One man pawning his livelihood and one chart going vertical off the back of it. Today, we're figuring out why both of these things are happening at the exact same time, and why the pawn shop counter might be the most accurate economic indicator we have left. Let's start with the mechanics, because most people misunderstand what's actually happening here. Jacob didn't sell his tools. A pawn loan isn't a sale. It's a collateralized loan. You hand over an item, the shop hands you cash, and you have a set window to come back, repay the principal plus the fees, and get your stuff back. If you miss the window, the shop keeps the item and sells it. Simple enough, right? Here's where the math gets brutal. If you borrow $500 against a wedding band for 90 days, you're going to pay around $300 in fees and interest to get it back. Put that same $500 on a standard credit card, and it costs you about $30. The pawn loan is roughly 10 times more expensive. Depending on what state you live in, effective annual interest rates run anywhere from 60% to over 200%. So why would anyone do this? Because there's no credit check, no application, no waiting. Nobody calls your boss. If you need $400 by Friday or your lights get shut off, the pawn shop isn't the worst option. It's the only option. And here's the kicker. The industry redemption rate is around 80 to 90%. People almost always come back for this stuff. But those fees, they don't come back. For millions of Americans, this isn't a one-time emergency anymore. It has become the plumbing of their monthly finances. Wall Street figured this out a long time ago. The big publicly traded pawn companies like First Cash and Easy Corp are pulling in record numbers. In early 2026, First Cash did over $1 billion in revenue in a single quarter. They had nearly $1 billion out on the street, lent against people's personal property. The market is in love with this, but investors aren't betting on the resale value of old guitars. They're betting on the IOUs. They're betting that the loan book keeps growing. Think about what that means. The market is pricing in the fact that more people will need emergency pawn loans next year than this year. I call this the desperation spread, the widening gap between a stock index hitting record highs and the lender of last resort posting record loans. And here is the ultimate gut punch. The asset managers running your retirement accounts own massive chunks of these pawn companies. Firms like Vanguard hold hundreds of millions of dollars in First Cash. So if you have a 401k, you are likely collecting a small cut every time a guy like Jacob rents his own tools back at a 200% interest rate. Your retirement portfolio and his rock bottom are sitting in the same mutual fund. If your mental image of a pawn shop customer is a desperate character in a back alley, update your software. That picture is decades out of date. Today's pawn customer has gone suburban, and they've gone upmarket. We are talking about small business owners pawning Rolexes, tradesmen with $3,000 tool sets. A massive chunk of the new growth in this industry is coming from households earning between $60,000 and $100,000 a year. These are people with jobs, mortgages, and on paper, they are the American middle class.
The pawn counter stopped being where you go when you're in poverty. It became where you go when you're fully employed, but just can't make the math work. Part of this is due to America quietly losing its bank branches. The U.S. lost roughly 13,000 bank branches between 2017 and 2026, hitting lower and middle-income neighborhoods the hardest. When the traditional bank leaves the strip mall, the 200% lender moves in 3 doors down. It's not a conspiracy, it's just what fills the vacuum. Let's zoom out to the macroeconomic picture. We are currently sitting in one of the most historically expensive stock markets in American history, rivaled only by the peak of the dot-com bubble in 1999. At the exact same time, the bottom 80% of earners haven't seen their spending power beat inflation in over 6 years. This is the K-shaped economy. The top 20%, the people who own the stocks and the real estate, are driving the economy upward. They're spending papers over the people on the bottom arm of the K, who are quietly drowning.
The distress isn't just a vibe, it's in the hard data. The personal savings rate has plummeted. Subprime auto loan delinquencies have pushed past the levels we saw during the 2008 financial crisis. People are losing their cars. But the most terrifying stat? A record number of Americans are pulling money out of their 401ks early for hardship withdrawals. They're eating massive tax penalties just to avoid eviction or pay medical bills. It is the financial equivalent of burning your living room furniture to heat your house. Now, before we declare the end of days, let's pump the brakes and look at the other side of the argument. Is the pawn boom pure economic misery? Not entirely. A massive piece of pawn shop inventory is gold. When the price of gold hits record highs, the same gold bracelet secures a much larger loan, and the shop's revenue inflates without a single extra person falling into financial ruin. Furthermore, the S&P 500 isn't really the American economy. It's heavily weighted by a handful of multinational tech giants that pull in revenue globally. Their success has absolutely nothing to do with whether Jacob in Detroit can make his rent. So a record stock market and a stressed-out middle class aren't actually a contradiction. They're just two entirely different universes that we lazily describe with the same word, the economy.
But here is the honest truth. The system has no slack left. When savings are high, the economy acts like a shock absorber. It can handle a layoff, an oil price spike, or a bad month. But when savings are at 3.6%, when credit cards are maxed, and when people are raiding their retirement accounts just to survive Tuesday, there is no buffer. It doesn't take a massive black swan event to break the system. It just takes a slightly worse week than usual. The stock market is an opinion about the future, made by people who are generally doing fine. The pawn counter is a mathematical measurement of the present, made by people who are out of options. When they disagree this loudly, it's worth asking which one is usually right. Keep your own buffer fat, keep your fixed costs lean, and don't confuse a record-high market with a healthy one. Thanks for watching. Make sure to hit subscribe, and I'll see you in the next one.